There's so many ways to make money trading options that most day and swing traders are not even aware of, yet they can be incredibly effective once you learn how they work and why. I'm Seth Freuberg, the head trader of STB Capital's options trading desk here in Manhattan, and the traders on our options desk are professionals and they have a clear understanding of the dynamics of options trades and how to put them together into powerful strategies that leverage the properties of options. So if you're interested in learning a very simple option strategy that can produce startling results under the right conditions, then stick around because I think you're going to find this eye-opening. Hi, I'm Seth Freuberg and I'm the head trader of STB Capital's options trading desk here in Manhattan. STB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so most traders think of options as a cheap, low-risk way of essentially betting on the movement of a stock, and there are certainly some guys on our trading desk who trade options in exactly that way and incredibly successfully. But there is another way to trade options that leverages them in a completely different way that can be just as powerful as the way that day and swing traders use them, and that has to do with what is known as the time premium that is built into every option that's traded. Now, before we jump into the specifics of the trade, let's just do a really quick review of the way that index options work so that everyone watching this video can understand this lesson. If you're experienced with index options, just hang in there because this is going to be quick and then we'll jump back into the lesson. Okay, so now almost all of you are probably familiar with equity options, where a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before the option expires, and a put option entitles you to sell 100 shares at the strike price of the put before that option expires. But there are also index options, which work similarly to equity options, except there's no such thing as 100 shares of an index like the S&P 500. You can't really buy or sell 100 shares of an index, but what you can do is get paid in cash, $100 per point, if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of an index put. So for example, if an index is trading at 31.50 and you buy the 31.60 call, if the index closes at 31.65, you get $500 in your account. If the index closes at 36.10 or lower, on the other hand, your call will expire worthless. On the other side of the ledger, if you buy a 31.35 put and the market sells off to 31.25, you'd make $1,000. But if the market just sold off to 31.35 or higher, the put would expire worthless. So those are the basics of index options. And remember, you can buy options, but your broker will also allow you to sell options. And your broker will allow you to put together combinations of options. In other words, option strategies that involve both short and long options purchased in a way that is advantageous to you as a trader. Okay, so with that as background, I'd like to illustrate this trade by going back to September of 2019, where the S&P 500 index was trading up around its all-time highs at that time, which was around 3,000. So let's take a look at what would have happened had we entered into what options traders refer to as a calendar spread. So the cleanest way of explaining this trade is by initiating a calendar spread that lasts about a month. So you can see that morning on September 18th, the SPX index was trading basically exactly at 3,000. So on that day, the market was pricing the 3,000 call expiring a month later on October 18th at $44.48, meaning that over the next month, the option seller was pricing the risk of the market rallying strongly and costing that seller a lot of money, and the option sellers were pricing that risk at that $44.48. And then moving over to the SPX 3000 strike price options expiring a month later on November 15th, the options market, as you can see, priced that risk, the risk of the market rallying strongly over a 2-month period, and it priced that risk namely at $66.08. And that makes sense if you think about it, because if the market has 2 full months to make a move, the chances of that move taking place are obviously greater than if that move is confined to the next month. And so that difference in price between the front month and the back month options at the same strike is the basis of why the calendar spread works, as you're about to find out. Now, before we get into why this spread works exactly, I wanted to let you know that there are many sound, viable long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit, month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit, whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing right now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just go ahead on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, now back to our calendar spread. Let's break down the cash flow on the entry of the trade so that we can track it as the trade develops. And so as you can see, we sold that 3,000 October call for $44.48. But remember, that pays off $100 per point above 3,000. So that is multiplied by 100 to arrive at your total cash flow from selling that option, which comes to $4,448. Now, to buy that 3,000 call in November, that has a cost of $66.08, as we mentioned. And as you can see from the calculation, that would cost us $6,608. And so the net cost to us is the net of those two, which brings us to a debit of $2,160 for entering into this trade, which is also the maximum risk of the trade. So that's how the calendar spread begins. Now let's move forward 6 days, and it so happens the SPX was trading almost exactly at 3,000 again, but you'll notice that the prices have dropped slightly. You see, the short call went from 44.48 down to 40.54, a drop of $3.94, while the long call also dropped from 66.08 to 62.59, a drop of $3.49, a bit less. And so since you're short the October call, and that lost more value than the November call that you're long, the net result is that you have an unrealized profit of $45 on the spread so far, as you can see from the calculation. Now, as it turns out, the next time that the SPX traded back around 3,000 was the final day of the trade, which of course is not going to happen frequently, but definitely can happen now and then. Now, because the short option expired on a day that the SPX index was trading at 29.86, which is below the price of the strike price of 3,000, then that option will expire with a value of 0 because it has no value unless the market closes above its strike price, as you'll recall. But, and this is crucial, take a look at the value of the long call expiring on November 15th. You'll see that that one has dropped in half in value to 32.97, even though the SPX index is trading very close to the same level it was, which was 3,000 at the outset of the trade. And that makes sense, right? There's still 28 days to go for that long option to expire, so there's still a lot of risk to that option seller that he'll have to pay off on that option. And so he still needs to charge a pretty large premium for that risk, although not as big as its original premium of $66.08 a month earlier. So both options have dropped in value, and that's because time has passed on both options, yet the price of the index itself hasn't changed that much. So now at this point, once that short option has expired, most traders would close this trade as it's no longer a calendar spread. Rather, it has just become simply a long call. And so therefore, let's take a look at where we are after the short option expires and we're closing the trade. Well, as you can see, the short option, the short call, expired worthless, as I mentioned. And so the full value of the premium we received for that one flows to profit. And the long option has dropped in value, but not as much as the short option. And so that difference, that relative speed by which the short option drops to zero and the long option loses value but continues to have value, the difference in that speed is why the calendar spread makes money, which in this case created a profit of more than $1,100, which is against the original required capital of $2,100, so that's more than 50% return in a month. While this won't happen a lot, where the market closes very close to the original entry price on the trade, the calendar spread can be incredibly rewarding in cases where that does happen. So the important lesson in this video that I'd like you to internalize is that calendar spreads work because of the relative value of the short options compared to the long options, which are farther out in time and have a greater value. But the short options lose their value much faster than the long, farther dated options lose their value. And so if the market doesn't move around too much, the fact that the short option loses value so much faster creates a profit for the trader just by the passage of time, really, which is one of the cool things about options income trading and one of the many concepts that the professional guys here on our desk utilize in their trading all the time. As I said earlier, if you enjoyed this video and learned something valuable from it, and you'd like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you're going to be getting through this free online workshop. So click on the link to sign up now. And please don't forget to click on the subscribe button right now so you won't miss all the free trading videos that we're posting constantly on our channel to help you and to improve your game as an options trader.